Hi, good afternoon. Welcome to the marketplace. Coming up, Bank of Ghana assures it is in a strong position to conduct operations despite more than 10 billion cedi loss recorded last year. We have analysis coming up. Also, government records 29.71% oversubscription of treasury bills as interest rates dip slightly. Thanks for being with us, everyone. My name is Darryl Kwao. Details coming up. Thanks for staying with us, everyone. First up, the Bank of Ghana has assured that it is in a strong financial position to conduct operations. This is despite the 10.5 billion cedi loss recorded last year. George Affe has more from the 2023 annual accounts in the following report.
Serious concerns about the Bank of Ghana and its ability to conduct its operations after the 60.8 billion cedi loss posted in 2022 and now the 10.5 billion cedis in 2023. But the Bank of Ghana in its annual report noted that it is in a position to generate enough income to cover all the stated costs when it comes to conducting its monetary policy operations. The central bank, for instance, identifies improvement in income earned from operations as another significant development that should give some market assurance. It also maintained that it will continue to carry out operations in a way going forward that would fast-track the expected turnaround. The central bank also announced in its financial statement that it is working to reduce exposure to government when it comes to financing and other measures, which it believes will improve its position going forward.
Well, meanwhile, the Bank of Ghana is attributing the loss recorded last year to the amount of money spent to check inflation by mopping up excess liquidity on the market. The central bank spent more than 8 billion cedis through its open market operations in 2023 by issuing bonds for these commercial banks. Persons close to the bank had argued that if inflation was not that high, they could have ended the year with a better financial position. Well, let's delve into this further. I'm joined on Zoom by research lead at GCB Capital, Khalid Bouti, to make sense of this. Good afternoon to you, Khalid. So, 10.5 billion cedi loss, that is considerable reduction from the 60 billion plus the central bank recorded the previous year. But what is quite worrying is that 8 billion cedi is trying to check inflation. What do you make of the losses incurred by the central bank?
Well, good afternoon to you, Darryl, and to your listeners. Yes, Bank of Ghana's situation is not desirable. Bottom line is the bank needs to capitalize, and that is not lost on anyone. I think different pronouncements from the governor and from even the statement, and of course from across the different quarters suggest that that is the inclination to fast track that. But back to the fact of the issue, we need to stabilize general prices, and that's the core mandate. And typically, Bank of Ghana, like any bank, will make revenue from interest income, other fees and charges and all that. From the revenue side, year on year, you could see growth. I think nearly 45 or so % growth you can see for the period. On the cost side of things, they did impairment again, which was within the circumstances necessary. There were also revaluation losses on FX and stuff like that, which again, given the circumstances, you could accept. But I guess the biggest pain they had was the cost of more operations, and they have to do so to keep inflation at bay. So policy rate very high, industry will complain, but it also does hurt the Bank of Ghana because they mobilized these excess liquidity from the system, which could prove inflationary if they don't do so, but or just around the policy rate. They call that the policy rate corridor. So a few basis points around the policy rate. And in doing so, these are monies they mobilize because they need to drain it from the system, but not monies they need to do anything with. So typically, if a bank goes to maybe get excess maybe liquidity assistance from the Bank of Ghana, then they could do so as lending to those banks and all that. But in the era where the banking system is cash rich and it needs to be mopped up almost always, it comes at a heavy cost to them, which is what we are seeing. And for the sake of keeping price stable, they have to do that. I guess that is in large part motivated the CRR directive that came, I think, in March or so, with targeted mopping up, from my estimation, over 19 billion or so at no cost. Because if they did not do that, they would have to mop up all those 19 billion at a cost around 29%, which will further drain them. But the positive in all this is that we have inflation at 25%. From the simulations I've done now, even if the risks are pointing to the upside, for the next 2-3 months, in fact, by end July, we should see inflation just around 20% or just under 20%. Now, if we get to those levels as expected, barring any shocks, there should be some cut in the monetary policy rate in July and potentially, and my projection for the year is about 400 basis point cut in total. Now, if we get policy rate to around 26%, the rest of the market rate will also react. And that is where the respite will begin to come from. But they need to anchor the disinflation process to be able to bring down the policy rate sustainably. And that is one way they can cut down that cost. And you can see the jump from 1.15 billion in normal operation cost to now over 8 billion. That's quite huge. And if they can bring inflation down and rates down, and policy rate also down sustainably, then that cost can be slashed quite significantly. And that will be the beginning of a turnaround. But it's not debatable the Bank of Ghana needs to recapitalize.
All right. The central bank, sources close to them saying that, well, this loss would not hurt the operations, the conduct of the operations. Are we supposed to be concerned about any risks?
Well, a typical institution which has your liabilities more than your assets plus equity, you may be approaching the levels of insolvency, depending on the case of the matter. But the Bank of Ghana is not a profit-making entity. They are not set up to make profit, right? And for their mandate, I think what is very important for them, as they have put out, is operational solvency. And by the definition of that term, operational solvency means that you generate enough revenue to cover the cost of your monetary policy operations. Last year, it was 8.4, and they made a revenue of 8.8. That leaves a difference of about 400 million.
Right.
400 million is a lot, but for a central bank, that is no money at all. And that is where the point I made earlier comes in. If inflation comes down sufficiently and they could anchor that outlook, and then policy rate can come down, it means their almost cost would also come down. And that 8.4 could come down quite significantly. You just need to look at it from the year before, and it was 1.15 billion. So that jump is quite huge and largely due to where the policy rate is. If it comes down, that cost reduced drastically, and then they could remain policy efficient. So it is doable, it's possible, and they can do it once inflation continues in the trend we expect it. But it doesn't rule out the fact that the Bank of Ghana needs to capitalize as soon as possible.
Right. Final question. Let's just assume that the central bank was not going to make any losses if it hadn't intervened in checking inflation, because it spent more than 8 billion cedis of the 10.5 billion that we are told was the amount of loss in checking inflation. What's the way forward? I mean, the central bank has been working to doing its part to keep inflation at bay, but there are still issues with the monetary side. And so how long can they keep on doing this, and what should be the way forward in tackling issues to do with inflation?
The way forward is prudence. Sadly, we tend to do that a lot during program, but outside of program, it becomes an issue. But it's prudence. More of what they are doing now, a lot of reforms going on. We see the MOU on zero deficit financing in place. My question has been that how long is this? Is it for the duration of the program or after? Because we've signed some of these MOUs like this in times past. Of course, I can understand the circumstances for the monetary interventions in 2022 and all that. But then How long is this MOU in place, and how are we sure that post 2026 or even 2028, when we are done and over with the program, we will not return to these kind of behaviors that led us to this kind of situation anyway? Of course, the central banks globally have the mandate to support in times of emergency, but those emergencies must be clearly defined, and the scope of intervention should be clearly defined. That way we can be maintaining prudence, right? So it's moral prudence, and then of course reducing the fiscal dominance. It is not up to them alone. It also depends on the central government to do what they have to do, and to manage the public finances more appropriately, to reduce the chances where we have had to fall on the central bank for support in these areas. A lot of what they are suffering today has been in 2022, where there were if you like, under subscription for the auctions, and there were risk of auction failures. They have had to step in to ensure that the local domestic fixed income market kept running, and people did not lose confidence long before we had to do debt restructuring. It racked up their cost, and they have had to deal with the impairment and things related. But if government does what they have to do, and we practice the best public financial management practices and get our fiscals in check, then the domino effect on the Bank of Ghana, and of course different other entities linked to that, would have been reduced really. So it's about the prudence from fiscal side, prudence from monetary side, to help stem this tide.
Research lead, GCB Capital carried with you. Thank you so much for speaking to us. Great to see you, my friend. All right, you're watching The Marketplace. Time to take a look at the financial markets. Government recorded a 29.71% oversubscription of Treasury bills a week after it failed to meet its target. Interest rates dipped slightly on the yield curve. Here with more update is Patrick Edemagama, who is head of trading at Republic Securities. Good afternoon to you, Patrick. So tell us a bit more about the outcome of last Friday's auction.
Good afternoon, Daryl, and good afternoon to the viewers. Okay, on the money market, we saw that the government raised a total of 3.52 billion, accepting and allotting bids against a target of 2.7 billion. And we can see that this target was actually a bit of an outlier compared to what we've seen in the previous weeks. It's a bit too low. That's how come we've seen the interest surging in this case. We've seen also that it was enough, the amount that was collected was enough to cover the maturing obligations for the week. It was actually 27% more than the maturing obligations, and this is also in preparations of what is coming in June. For the 91 day, we've seen it clear at 25.0385, dropping slightly by 6 basis points. We've seen the 182-day clearing at 26.9173%, decreasing by just 3.23 basis points. And also the 364-day cleared at 27.9093%, also decreasing by just 4 basis points.
Curious to know what triggered the comeback from what we saw the previous week when the government failed to achieve its targets.
Well, what we saw last week is that interest is actually increasing in the market. Aside the target being low, we've seen interest increasing. If you look at the secondary market, we saw volumes traded in the secondary market inching up by 20% to 2.494 billion Ghana cedis. So we are seeing interest come up. Also, we've seen that the bonds that traded last week inch up a bit. Normally, we see the bills taking the greater portion of the secondary market trades, but we saw the bonds last week inching up to 24% compared to the 76% that the bills took for last week. So we can see confidence coming back into the market.
What's happening with interest rates? We saw a slight dip last week on the yield curve.
Well, so for the week before last week, the target was really high. We saw a target of 4.8 billion. This week, we saw a target of 2.7 billion. So that's how come we are seeing that volatility in the interest. The coming Friday, we are seeing target of 4.4 billion. And we expect that one to also be subscribed and looking at what's happening on the market, if the confidence level increases, again, it might be slightly oversubscribed for this week.
Are we seeing any impact following the central bank's decision to hold the policy rate at 29%?
Well, no, we're not yet, but we know investors are looking for confidence in the market. If investors feel that the government or the central bank is on top of its game and the confidence is there, then they will be confident and know that the indicators can be predicted, or they can be able to estimate what will happen in the coming months, and then they can be able to place their funds. So fund managers, pension fund managers, all that they are looking for is the confidence level. And once the confidence level is inching up, we'll be able to see more funds being placed in the markets.
All right, a quick stock market update. Bob, Benzo Oil Palm Plantation and Total Energy is expected to record some gains this week. What's the update on the stock market and the outlook for this week?
Well, on the stock market last week, we saw some four price gainers. There was a lot of interest in New Gold, GCB, Total, and Benzo Oil Palm. Even today, we are seeing a rise in the price of GCB already. So we are seeing interest again mount in stocks like SIC, Atlantic Lithium, Benzo Oil Palm, Total, and GCB. We expect their prices to go up slightly if this interest actually continues. On the flip side, we are also seeing the sell side mount for MTN and Enterprise Group. It's actually mounting week in week. So we think if this continues, that they can also lose some pesos on the market.
All right, Patrick Edemagama, Head of Trading, Republic Securities. Appreciate the update. You're watching The Marketplace. Let's turn to other stories for you this afternoon. Prices of vegetables like carrots, lettuce, green pepper have seen a sharp increase affecting their sale on the market. The situation is forcing many vendors to dispose of the perishable goods, as some traders say they are beginning to record those sales and cannot break even. Live business engaged actors in the value chain as experts predict an influx of the commodity in the coming months.
Helen, a vegetable trader at Ejiso Market, explains the cost of the varieties of vegetables she sells.
I can't sell this at a lesser price.
Dorcas, also a vendor, sells cabbage, lettuce, and other vegetables at the market. The cost of her commodities have shot up twice the usual price.
You could get more for the vegetables you buy, but you will get less.
Bako 5, 4, and 3.
Prices of vegetables have in recent times increased astronomically, seeing an almost 100% price surge. The traders attribute the price hike to the scarcity of the commodities and cost involved in transporting them from neighboring countries.
We import some from Asante Mampong and others from Morocco. They are scarce because of the low rainfall. The lorry fares have also shot up the price.
Ghana has over the years imported a number of its farm produce like vegetables from neighboring countries, including Cote d'Ivoire, Burkina Faso, Niger, and Mali. The incessant taste for foreign produce begs the question, what is happening to the agricultural sector? Experts attribute the dwindling sector growth to the changing weather pattern and other logistical support for industry players, especially farmers. Dr. David Anambam is Director of Agriculture in the Ejiso municipality.
And during the off-season, those who are not under irrigation, many farmers are not farming. So the few that are left, demand and supply, the few that are left, definitely the demand is higher than the supply, then that will shoot up the price. If you want to promote agriculture and the rain-fed, I don't think we can go far.
Anthony Otre, a vegetable farmer in Ejiso, like many farmers across the country, faces existential threats to his inherited farming business.
The
high temperature burnt all my produce. I nearly gave up. For centuries, farming in Ghana solely depends on rainfall, which agricultural experts say is a bane to the growth of the sector. Dr. Natson Amengo is an agricultural economist at the Crops Research Institute of the Council for Scientific and Industrial Research.
If we want like an immediate solution, it will be improving on the access roads. Then, if we are looking at the long term, we should be looking at moving away from rain-fed agriculture and looking more at irrigated systems. We should also start looking at improving our processing systems and our storage facilities. Because sometime in the year, you see that we have certain commodities in abundance. Then after a while, just even about 2-3 weeks time, you can't find them again, just because we don't have enough storage capacities for them.
The increased prices of the commodities is heavily affecting their sales as the traders begin to experience low sales and post-harvest losses.
Our commodities are spoiling. We have to dispose them off.
But despite the prevailing scarcity and challenging economic climate, vegetable consumers and traders should expect an ease soon.
I tell you, in June, the middle of June to July, you see this change, there will be a change. Because everyone will go into the vegetable production and then the market will be flooded. Tomato that you were buying 50 cedis, you see it being sold at what? Maybe 20 cedis.
For the time being, lovers and vendors of vegetables must bear the brunt of soaring commodity prices. For Joy News, my name is Emmanuel Bright Kweku.
Also in the news this afternoon, Deputy Managing Director of Tallow, Cynthia Lumo, has said that the partnership between the oil firm and Youth Bridge Foundation will establish a crucial network to provide young people with accelerated support through mentoring and essential skills training. She shared these insights at the launch of the Tallow Alumni Connect in Accra.
The launch of the Tallow Alumni Connect in Ghana showcases Tallow's enduring commitment to education and strengthens its partnership with the Youth Bridge Foundation. Deputy Managing Director of Tallow Ghana, Cynthia Lumo, stated that the network aims to reach 1,000 students each year.
Beneficiaries of the partnership with Youth Bridge Foundation are among some of the critical mass of emerging leaders in key sectors of the Ghanaian economy. One of the principal reasons for launching the Alumni Connect is to invite you, past scholars, in addition to beneficiaries of various Tallow tertiary scholarship projects, to become part of a community of alumni focused on supporting young people through mentoring and essential skills training. Ultimately, we aim to reach 1,000 students per year and link about 600 beneficiaries to employment opportunities through the network. It will initially be a one-year pilot, aligning with Tallow's community strategy of accelerating progress through partnerships.
Cynthia Lumo further emphasized Tallow's dedication to increasing investment in educational infrastructure.
A few years ago, Tallow made a commitment to invest $10 million in educational infrastructure over 5 years, for 15 senior high schools in support of Ghana's education agenda. That was in addition to the scholarships that supported over 1,200 secondary students and over 1,000 tertiary students, scholarships of different kinds. But we know that there's more to be done, and we are not resting on our laurels.
A beneficiary of the scholarship program shared her positive experience.
This scholarship is more than a financial aid. It is a beacon of hope and a testament to your belief in the power of education and to transform life. Through your support, you ignite the potential within us.
All right, and that's the marketplace. More news on our website, myjoyonline.com/business. The day's latest stories there, myjoyonline.com/business. Leaving you with today's episode of Money Lab.
Hello, welcome to today's edition of Money Lab. My name is Nana Asante Amwakon, Head of Consumer Experience at Enterprise Trustees. In our previous edition, we discussed the employees' benefits under the 3-tier pension scheme. Today, we're going to talk about the Tier 2 pension scheme. The Tier 2 pension scheme is a mandatory contributory scheme. It operates at a monthly contribution rate of 5% of the basic salary of all employees. This scheme is efficiently managed by NPRA's licensed service providers, ensuring both oversight and reliability. Contributions to the Tier 2 are entirely tax exempt. As a member of the Tier 2 scheme, your retirement is secured with a lump sum benefits payout during retirement. This payout comprises all the contributions you've made over the period and the accrued benefits. So we come your way again in our next edition. Remember to plan well, retire well.